Welcome to This Week in Money. I'm Jim Goddard. Today, a special edition of the show focusing on the crisis facing Canada's junior equity markets. My guest is Rory Godinho, head of the Boughton Law Securities Group and a member of the TSE Venture Exchange Local Advisory Committee. He'll look at how the exchanges ran into trouble, the issues involved, and some of the possible solutions. We'll talk to Rory Godinho right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Rory Godinho, head of Boughton Law Securities Group. He's on the TSX Venture Exchange's Local Advisory Committee. His firm represents several issuers and independent investment dealers on the exchange. Our show this week is going to concentrate on the declining state of Canada's junior capital markets and suggestions on how to solve the problems that have caused it. Welcome to This Week in Money, Rory.
Thank you for having me.
Perhaps, Rory, we'll get a little bit of history here about why we've fallen into this, and then discuss some of the ideas on how we can turn things around and make the junior exchanges healthy and a place to put your money again and see it grow and help Canada grow.
Well, I think if you look at it historically, in the early 1900s, the Vancouver Stock Exchange and Alberta Stock Exchange were formed to facilitate capital raising and trading of speculative ventures. And when I say speculative, I refer to high-risk, high-return ventures. And over the time, the exchanges and ancillary service providers and the industry prospered on the risk-tolerant nature of Western Canadians. So over the past century, we've built up a very sophisticated world-class infrastructure for the venture industry. And that community includes the exchanges themselves, investment dealers, service providers such as lawyers, geologists, accountants, engineers, transfer agents. So, the multiplier effect is really enormous. And we are facing very difficult times, really since 2008. And I think if we don't make some accommodative changes, we risk losing a tremendous amount of business in the province. I would say that we're not the only smart people in the world. When I started in this industry, you didn't see qualified geologists and engineers from less developed countries. We had advantages that were shared by very few, such as Americans and Australians. But now you find very qualified engineers and geologists from places like Peru, Brazil, Colombia. List goes on. And sooner or later, some other country will decide that they can facilitate venture capital as well or better than we do. And there's already several exchanges in South America that are contemplating exactly that.
And that's competition that, say, 8 years ago, you wouldn't be thinking about.
Absolutely wouldn't be thinking about it. I mean, Vancouver has been the global center for, of expertise for mineral exploration. We have, some 1,200 exploration companies located in British Columbia, many of which are in the Vancouver area. And we have a tremendous infrastructure. There's, firms that provide technical, legal, financial, accounting, environmental advice. It's a very big industry.
In this case, you're not exactly killing the goose that laid the golden egg, but you are slowly strangling it to death.
That's I think what is happening. It's a combination of things. It's not just a lot of people look at it and say, well, this is a cyclical nature of the industry, and certainly on the resource side there is some merit to that argument. But, fundamental things have been changed over the last few years, and I think we have to deal with those fundamental changes. I mean, we're now facing the lowest financing activity on the exchanges, on the venture exchanges since the 1980s, horribly decreased availability of capital, reduced number of deals, dearth of retail investors, an increase in regulation and structural changes to the banking and brokerage landscape. So there's, it's not a simple solution. There's many issues that we have to deal with.
How could you explain the current venture resource financing climate?
It's very poor. It's probably the best explanation. But, I think the question that you originally asked is how do we get here? And I think the answer to that is that what happened over the years is that with higher commodity prices, there was an ability to raise much larger pools of capital, and that in turn attracted professional management with the ability to deal with more advanced projects, which in turn attracted institutional money. And you have to understand, the institutional funds are very sophisticated and attractive to investment dealers' sales desks, because if you think about it, if you can raise $20 million by making 10 phone calls to institutions rather than 500 phone calls to retail investors, that's what you're going to do. So over the past time, the retail investor has become somewhat marginalized, and retail participation in financings dropped precipitously. And then along came 2008, and the institutional funds that were, beginning to monopolize the financings were faced with redemptions and forced to exit the venture capital sector. And retail investors had fled the market, which has all resulted in greatly decreased availability of capital.
Now, in December of 2014, the venture exchange index fell below the previous all-time low seen in the economic crisis of 2008. We weren't in a crisis. How could that happen?
Well, I think a lower tide takes all boats with it, and that's what happened, unfortunately. And I think if you look at the economic crisis, the prevailing notion was that there was going to be less need for commodities, and as a result of that, commodity prices have plummeted in some cases, and that's a large part of why the resource sector in the market is suffering. They haven't; a lot of commodity prices have not recovered.
So how exactly is the fact that we're seeing fewer deals worth less money affecting the overall climate for investment in Canada?
Well, I think the impact is profound. Right now, there's very much a lack of support for the junior market. I think there's statistics out there, and John Kaiser of Kaiser Research is a very good source of statistics. I think he said the latest there's probably 500 or so issuers listed on the exchange, on the venture exchange, which have negative working capital. So, some of those companies have good projects which will never be financed. And you need, in my view, you still need junior explorers to be out there looking for and developing assets, property assets. Because when you think about it, those are the types of issuers that have been the source of the entire diamond industry in the Northwest Territories. If it wasn't for junior explorers finding diamonds where no one else would have looked, we probably wouldn't have the huge diamond industry that we now do.
Yes, who thought you'd ever find diamonds in Saskatchewan, for example?
Yeah, hard to imagine, but there they are.
Well, what about institutional investors? Are they now backing away? Because I think the statistic came up about 80% of what people raise now, money that they hope to use for exploration, now goes to regulators, lawyers, the government, auditors. And so that's only 20% of the money they raise going out there. So are institutions, wary of getting involved because they're not getting a lot of bang for their buck in the long run?
I think that's a very good point, and it's a sort of a two-pronged question. There are lots of institutional investors still around, but the speculative nature of venture mining projects frequently put them outside of the investment profile of institutional investors. And on top of that, I think one of the things they really discovered in the 2008 crisis was that liquidity is a big issue. Liquidity is of paramount importance to institutional investors because if they are forced to liquidate a position, they need to do it quickly. So when there is very little liquidity available to them, they simply won't invest. And so I think that's what you're seeing in the junior market. There's so little liquidity that institutional investors will only invest in the best of the best and companies that have good liquidity in their stocks. As far as the funds being invested into or spent on other than exploration and development, I couldn't agree with you more. Unfortunately, we have a situation where a large portion of the monies raised goes to administration and including legal, accounting, filing, compliance. There's just a host of different uses of funds which take away from the money that's available to be put actually in the ground. And I think that affects both institutional and retail investors.
Well, Rory, you wanted to do a dramatic presentation for me, saying you wanted to show me just one document you prepared for a project. Maybe explain what that document was and just how big it is.
Well, so, we just finished what's called a reverse takeover of an issuer listed on the TSX Venture Exchange. The company being subject of a reverse takeover was a shell trading at 3 cents, had been listed for many, many years on the exchange, and entered into a transaction to become a technology issuer. We just finished and mailed the information circular. The information circular itself is 100 pages long. There's about 300 pages of financial information attached to that. So it's a 400-page document, basically. And my view is that for the shareholders of that company and potential investors, no one's going to read 400 pages of documentation. The only people who read that are lawyers and regulators. So I think we defeat the purpose a little bit, and that's arguing against my interest because we get paid to put these huge documents out there. But I just don't think it serves the purpose for which it was designed, and I think we have to really consider that. In my view, for example, I think we could probably say everything that there is to say about a resource issuer in about 25 pages in a disclosure document, and then, add in by reference the ability for investors to go to CDR and check technical reports and things like that. But the real gist of it is does not need to be 300 to 400 pages, and of course it costs money to do those types of documents. Right, especially if you have a lot of shareholders. Absolutely, you have to send them to your shareholders, and we have to embrace innovations. I mean, things have changed very drastically with the use of the internet, and I think there are some efforts to do that, which I'm happy to see, but we have a long way to go. We'll have more with Rory Godinho right after this on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to Rory Godinho. He's the head of Boughton Law Securities Group. He's also on the TSX Venture Exchange Local Advisory Committee. And we're talking about ways to help improve the junior exchanges here in Canada so they become, again, a very useful way to develop business here instead of, it seems to me, throwing up every roadblock in the world they can do. Now, in Vancouver, we used to have, I think, close to 40 brokerage and security firms that looked after investments here. What has happened to that large group?
Well, unfortunately, they've been decimated, and I think what you're referring to is independent investment dealers. At the time that the exchange was called the Vancouver Stock Exchange, there was about 37, 40 independent investment dealers headquartered in BC. That number has plummeted to, I think, about 8 or 9 right now in the market. And I think, it's a gloomy prediction, but I suspect that may bottom out at 3 or 4. Just last week, one of the BC-based investment dealers announced that it's merging with a national firm headquartered in Toronto. And I think what's important is the role that independent investment dealers play in the market. It's a very important role in that they are the liaison between the issuers looking to raise capital and the investors interested in providing same. But unfortunately, over the past few years, their business is rapidly changing. The business conditions are rapidly changing. There's the rise of online discount trading, which has really affected their commission revenue. There's competition from exempt market dealers who focus on the accredited investors. And there's increased regulatory burdens that cost them a lot of money. I've heard statistics saying that 60% of their revenues go towards compliance issues. So that's a huge amount for these dealers, and they're in poor markets they just haven't been able to survive that confluence of events. So it's a very important issue. I think it's something that a lot of attention needs to be paid to because there's a major difference between investment dealers and banks, and we can discuss that a bit more as well.
And of course, there's the rule that if you owe money to your accountant, your company can't file an annual report. And now, is that a good rule or a bad rule?
Yeah, it's an annual financial statement, and I'd have to say, I mean, that is a good rule. I think it's a question of conflicts, and I think you don't want to have your accountant or auditor in a situation where they have a conflict because they're owed a great deal of money. So, I think that's a good rule.
So what can regulators do to reconnect retail investors with the junior resource industry?
Oh, there's a lot of things I think we have to look at, and I think the regulators have to get a better understanding of the challenges faced by the junior companies. As I said earlier, the issues are not just cyclical. There's fundamental shifts affecting the venture capital industry, and if we want to have a junior resource industry in British Columbia 10 years from now, we need to implement some serious regulatory reform, which I do believe can be accomplished without damaging the integrity of the capital markets. I think there's some encouraging signs. In the past few months, the Canadian Securities Administrators adopted what's called an existing shareholder exemption, which we had campaigned long and hard for, to re-engage in retail investors who are unaccredited. There's several other initiatives underway, and I should say that the British Columbia and Alberta Securities Commission have been leading the initiatives to deal with some of the issues and that we've discussed, and but they have had trouble engaging the community in these efforts, and that's a bit of a communication issue, I think. But some of the things that are being proposed are rights offering exemptions, a new rights offering exemption, which I think would be very useful. It's a simplified exemption from what the current regime is. It would allow existing shareholders of companies to subscribe to rights offerings based on very short disclosure documents and do it in an efficient manner. Which was designed to be cost effective for issuers, and the theory, of course, there is that retail or existing shareholders already know what they know quite a bit about the issuers that they've invested in. There's another proposal that we hope to assist with, and that's an investment dealer exemption. I think that would help both the investment dealers and issuers. So those are, there are certain initiatives being pursued, and I think we need to spend more time and really push some of those initiatives.
Now, the existing shareholder thing that you were talking about, does that have to do with the fact that right now the regulations won't let people who are 65 or older invest in the venture exchanges because they say it's too risky for you? But what if it's somebody like Jimmy Pattison, who probably is the sharpest businessman on the planet?
Oh, I've heard that story before, and it's a good story. I won't repeat it, but I'm sure it's. I think that was referred to in one of your earlier episodes. Absolutely. I mean, the problem we have is that the existing exemptions which allow investors to participate in direct financings from companies as opposed to investing in the market are pretty restrictive, and one of those categories is the accredited investor exemption, as it's called. And you have to understand that the requirements for that exemption are based on financial criteria. Depending on how much you or your family has earned, or how much assets you have, not including your residential premises. And unfortunately, that whole category of people over the past few years has shrunk somewhat because a lot of investors in the junior markets have in fact lost money over the past few years. So the pool of investors has been reduced quite drastically. And we also have to understand, I think one of the big issues that hasn't really been explained much is that I think we do have a bit of a demographic issue involved, and that is that people who are part of the baby boom are getting older and are becoming more conservative, and rightfully so. So, and the sort of younger generations have not really been involved in or taken up the junior markets as much as that generation has.
Yeah, and it might be the fact right now, if you ask a kid, where does milk come from? They don't say a cow. It comes from the grocery store. And maybe younger people don't understand that light bulb began its life deep underground somewhere.
Well, you know, the younger generation, and I have kids in the sort of 20, 21-year-old age. They are enamored with technology. So, you know, when we look at, when they look at investments, they're far more likely to be interested in technology companies and technology investments than they are in mining companies. And I think we haven't done the best job of explaining that most of the technologies, or the hardware certainly, are built using commodities. So I think there is a bit of a disconnect there, and it's a difficult one. If you go to, and I'm sure you do, if you go to many of the resource shows as an example, or the conferences, you'll find that the average audience is I'd say of advanced age. There's very few young people there.
That's very polite of you.
I'm one of the advanced aged.
We'll have more with Rory Godinho when This Week in Money returns.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking to Rory Godinho. He's the head of Boughton Law Securities Group, and he's also on the TSX Venture Exchange Local Advisory Committee. Rory, you said the banks and the securities dealers seem to have be at cross purposes here. Is there conflict, or is one side winning? Maybe explain that.
That's not conflict. It's just that they're, you know, very different animals, and the difficulty that we have is that with the pressures that independent investment dealers are facing has resulted in a disconnect between venture issuers and retail investors, and that, combined with a push by the big banks towards fee-heavy structured products like mutual funds and ETFs, have made it incredibly difficult for even the most eager retail investors to participate in the venture market. And I think what you have to do is you have to understand that there's a big difference between banks and the independent investment dealers. Banks are far more risk-averse, and their advisors are very reluctant to recommend investing in speculative ventures. A good example of that is, you know, I have investment accounts at both a bank and several brokerage firms, and I can tell you whenever I ask my bank investment advisor about a junior security, he gives me a strange, displeasured look. So, you know, they just don't follow the junior market, don't understand how to trade it, and generally are not interested on all but the most senior issuers. You know, they are much more inclined to sell structured products in the case of the resource sector, that would be ETFs. Banks are interested and very well suited to senior issuers. We have local offices of the banks, such as BMO, that do a great job of financing major resource issuers, but they don't really have an inclination to finance micro-cap companies. And you know, in my view, there's retail investors who are still interested in putting some of their portfolio in speculative investments. We still have great success stories, but without support from brokers and media, I think the public is unaware of some of these stories. For example, we have a client that was the number one mining performer on the TSXV and graduating to the TSX on Monday, and last year it returned 420%. So I can assure you that any investor who participated in their financing at the beginning of the year was really thrilled with the performance of that company. You obviously don't get that kind of return on more senior type investments.
Do you think there are investors who want to put their money into things that others would consider quite risky?
I think there's investors. I mean, there's a huge plethora of investors, but certainly I think most investors would consider putting a small portion of their overall portfolios in high risk, high return investments.
And as you said, the returns can be spectacular. How can we convince the people who regulate these authorities for securities that perhaps people need some more encouragement, and maybe if it was explained to them better, they might take a look at putting a small portion of their portfolio into something risky?
Well, I think it's a bit of an education process. in the long term, I think we have to consider educating the younger generation right through high schools. We have to do a lot more than is currently done to educate the investing public about junior issuers. Right now, most of the education, most of the media you see is warning people about the dangers of speculative investing, and there's a reason for all that as well. But I don't think people really understand the value of some of these junior explorers and developers. As I said before, we probably wouldn't have the diamond industry in Canada that we do if it wasn't for a couple of intrepid explorers, from Kelowna, in fact, and Vancouver. So I think it's just an education process. I think on the regulatory front, there's quite a bit we can do to reduce or make it proportionate.
Are there actually education programs for young people to do that?
I don't know the answer to that question. I'm not sure.
In other words, if there is, they're keeping it a secret.
Yeah, I'm an advocate of, as I said again earlier, I think young people are enthralled with technology devices, and they don't really connect the fact that most of what we have is made up of minerals that are mined somewhere or other in the world. How do we get retail investors interested? Retail investors, there's a number of things I think we have to do. I think we have to focus on enhancing their opportunity to profit from speculative trading. I'll give you an example. When we were coming up with the genesis of the existing shareholder exemption, it was based on the realization that many of the existing issuers were going to have to reorganize to survive. And that usually means that issuers consolidate their existing shares and then refinance. And historically, promoters or insiders would position themselves in the insider once the consolidation was completed by participating in a new financing to the exclusion of others. So we argued that existing shareholders who had suffered the consolidation should have the same opportunity. They may not be happy about the consolidation. If you had 1,000 shares at 40 cents and you're consolidated 10 for 1, you're down to 100 shares at $4. But at least they'd have the opportunity to average down their cost and participate on the same basis as insiders. So when you're given that opportunity, you can decide whether you want to back that management team again or not. But you don't feel you've been excluded from the reorganization. So the TSX Venture Exchange strongly supported that initiative, and eventually all the CSA jurisdictions enabled that exemption. We're now pushing for a couple of new exemptions, one being an investment dealer exemption. And the thesis behind that is investment dealers have huge compliance costs in their capacity as gatekeepers, but no real advantage vis-a-vis clients relating on their know your client or know your product obligations other than trading in the secondary market. So what we're proposing is that retail investors be allowed to invest in issuers by relying on advice from their brokers without having to meet the accredited investor requirements or any other exemption for that matter. And we think that would invigorate the retail investors by allowing them unprecedented access to private placements. Another thing that we plan on advocating is the reduction of hold periods associated with private placements. The world of communication has advanced considerably since the hold period was reduced from 12 months to 4 months, and we submit that further reducing the hold period to a month or two would greatly enhance investor appetite for speculative securities. The TXXV is working on reducing order fragmentation, and both the TXX and IROC are studying high-frequency trading and the effect of the elimination of the uptick rule. Maybe explain what's happening there. Well, the order fragmentation is because there's a lot of alternative trading mechanisms that have been introduced over the past few years. It's just become sort of added a bit of confusion to the marketplace. So the TSXV is looking at consolidating some of those. And then there's been lots of complaints about high-frequency trading, algorithmic trading, and the elimination of what was called the uptick rule, which prevented shorting unless you had an uptick on the stock. And I'm certainly no expert on all of that, but I do know that it is being studied very carefully by both the TSX and IROC.
Yes, because the major stock exchanges have found out that some security firms are moving their investment house closer to the actual building where the trades take place, because that nanosecond difference in transmission time means they can get a bid in before anybody else.
That's right.
And of course, people say, what, a billionth of a second can make a difference? Well, with high-speed computers, it absolutely does.
Absolutely does.
So you'd like to see everybody back on the same trading page where maybe there's a 3-second or however long it takes for an electronic signal to go around the world, I guess.
Yeah, they call them speed bumps, so which is, of course, a nice colloquial term for it. But yes, there's a new exchange, the Neo Equitas exchange, that has just started operations, that has a system that introduced speed bumps, and I believe the TSX and TSX Venture Exchange are also heading down that path as well. So the idea is to have a level playing field.
John Kaiser has suggested some ideas on how to improve investor interest. What are some of those ideas?
Well, John's got a lot of innovative ideas, and he would like to change or eliminate the accredited investor definition because he feels it's very restrictive. He's also come up with a very different idea, which is to allow investors to open brokerage accounts where they take 100% of personal responsibility, so they're not relying on anyone's advice, and allow those accounts to participate in private placements. So he has very interesting thoughts. He's also suggested a gaming model for sort of visualization of the development of projects where it's basically an online interface that allows users to imagine an ore body and turn it into a simplified mine and apply discounted cash flow methodology, and then let others critique the model. So he's sort of expecting that you'd have engineers, geologists from around the world sort of critiquing something that's put up on an internet site. So those are some of the things. You may want to refer people to a talk he had with the BC Association of Mineral Exploration on December 9th, 2014. It's the slideshow is posted on his website, www.kaiserresearch.com. It's very interesting, very informative. And John is amazing with statistics and some of his thoughts.
Rory, we're going to talk about why you don't think a National Securities Commission is the solution to the country's problems for raising money for venture exchanges. And also, we'll discuss some possible solutions to the problems facing junior markets. Rory, a National Securities Commission, good or bad idea in your opinion?
Well, I think it's it's kind of a mix. That's the problem. I'm not opposed to the idea. I think what people should understand is that unlike some of our foreign economic counterparts, Canada still maintains a patchwork of provincial securities regulators, and the current regime creates inconsistency in the regulation of identical securities within the country, and causes increased expense for issuers in terms of regulatory filings that sometimes need to be made in multiple jurisdictions. So the argument in favor of a national securities regulator is that it'll streamline regulation and create consistency amongst the provinces, and save issuers cost in their filings. So that's absolutely great for large, well-established issuers such as Canadian Tire or Air Canada, or in fact most of the TSX-listed issuers. But my concern is that a national regulator headquartered in Ontario simply doesn't appreciate the significant differences between the senior markets that prevail there and the junior markets that sort of are more prevalent in BC and Alberta. And so unless the rulemaking affecting venture markets for such an organization were given to BC and Alberta, if that province ever signed on, I think there could be major issues for the venture industry.
And I know Quebec as well has raised concerns because they say that people don't understand what's going on here simply because it's in French.
That's right. I'm not going to comment on that.
But I'm sure they have the same concerns. Would you look after our interests just as well as you would for Central Canada? would headquarters in BC or Edmonton or Calgary, of course I would pull for Vancouver for a good reason. We've lost a lot of our head offices. It would be good to have some of that expertise brought back to the coast. So, what do you have to do to convince people it would be a good idea to have that commission placed here?
Well, I think you'd have to have, I don't know if you'd have a commission headquartered in BC, but I think if you could have BC and Alberta as the sort of the principal focus of regulation for venture issuers, that would probably suffice. And it's not a parochial view I'm condoning here. It's just that, as an example, when BC and Alberta proposed the existing shareholder exemption as a somewhat of a crisis response to the state of the markets, all the provinces across Canada quickly signed on, other than Ontario and Labrador and Newfoundland. And it took those jurisdictions many, many months to finally be convinced to adopt same. And when they did, they implemented slightly different regulations so that there's still an inconsistency across the Canadian Securities Administrators. So another example is last year I was at PDAC. I was on a panel with the directors of corporate finance for BC and Ontario. And, both of them great young guys. But while BC was pushing the new existing shareholder exemption, the Ontario director was saying that they were studying and had great hope for an offering memorandum exemption. Now, that's funny because BC and Alberta have had that exemption for many, many years, and BC has discovered that issuers rarely ever use same. So they're just sort of out of touch with what's been going on, in terms of trying to be proactive and deal with the status of the industry as it is today.
What are some of the other problems that you've encountered that the junior markets are encountering right now, and what are the possible solutions for them?
Well, I think there's, again, I'm an advocate for retail investors and an advocate for investment dealers. I think investment dealers are having a very difficult time because of the CRM models, the customer relationship models that are imposed on them by IIROC. It's really choking the lifeblood out of some of these investment dealers, and it results in what John Kaiser calls the rocking chair nation, so what he likes to colloquially call it. I love that expression, but I think that's a bit of an issue. I think we need strong oversight, industry oversight, whether it's with a national regulator or the British Columbia Securities Commission. One of the biggest complaints we hear is that they just don't have the ear of the investment community. We represent several constituents that are of the view that the commission should have commissioners with more industry representation. Last I checked, I think about 7 of the existing commissioners are lawyers and 2 or 3 accountants, and there's no issuer or dealer representatives. So, we've heard that they need more industry representatives, or that there should be a formal industry board that liaises between the government and the commission.
What about the government? Provincial governments, federal government, where are they on this?
I think, the provincial government has the authority currently to regulate securities in the province, and I think, we've had some meetings with them. They are aware that there's issues involved, but I think we probably need to be more proactive and bring it to their attention, bring possible solutions to their attention. Everyone sort of knows the problems, but I think we have to look at solutions. I think it's a community-wide issue because the BCSC, for example, had proposed some measure of proportionate regulation, which would reduce the burden on junior issuers. And what they do is they put out their proposals for comment from the public, and for something that we hear thousands and thousands of people harping on and saying we need to have less regulation, reduced regulation. I think they got 13 responses, and 7 of them were not in favor. So I think there's a real disconnect between the regulators and the public, and I think we have to somehow fix that problem.
And of course, making sure that potential investors are aware of the risks of the market and making sure that they're aware. Why can't they participate? That would be probably a big way to reduce some of these regulations.
Well, I think you have to. You have to understand it is speculative investing, and at the end of the day, you can lose your entire investment. I think that's what we need to focus on always. And so the programs that have been put in place to prevent abuses in the market are good programs. But I think what there needs to be is we need to use, I think, perhaps technology a little bit more. Going back to some of my statements, when I talk about proportional regulation, I'm really talking about the disclosure requirements that that focus on what an investor needs to know in order to make an informed investment decision, and to strip that process from the comprehensive prospectus offering forms and lengthy disclosure documents. We've swung so far over to litigation mitigation that we put out disclosure documents that absolutely no one other than regulators and lawyers read. And I firmly believe we can describe everything in much more succinct form, and I think we need to be innovative. For example, lawyers love to put in risk factors in all our documents, and you could probably compile a huge compendium of risk factors and put them on a commission or exchange website and state that any speculative investment or investor should be aware that these are the risk factors. So I think we just need to think about how we approach the whole disclosure regime and how you make it simpler for people to understand what they're buying.
Are there regulations in other countries that maybe would work well here in Canada?
Well, we look, at very many jurisdictions. The new rights offering proposal that the commissions have put out to the public for comment are derived quite a bit on Australia's rights offering regime. So, there is an effort to always look at what else is going on around the world. One of the things I think that we haven't paid enough attention to is the Jobs Act. It's a U.S. stimulus program that was brought in December, I think, 2013, where the Securities and Exchange Commission, the U.S. Securities and Exchange Commission, issued proposals to implement what's called Regulation A+, an offering exemption. And under that proposal, it would permit U.S. and Canadian companies that are not SEC reporting issuers, and I think a lot of Canadian companies would fit into that category, to sell up to $50 million from Treasury offerings in any rolling 12-month period, which with greatly reduced regulation and related expense, and then immediate subsequent public trading of the purchased securities. So, that's a kind of initiative that I think the Canadian Securities Commissions and the exchanges should be major advocates for implementation, as it would probably be the biggest single stimulus to revive the market.
Of course, American markets are much bigger than Canada. Their junior markets would loom over some of the larger firms in Canada that are on the Toronto Exchange. Is there any way that we can scale down the U.S. regulations to make them workable in Canada?
No, I don't think so. I mean, there's, again, they're different markets. I think what's more important is to allow, this example, the Regulation A+ example, is if you could allow Canadian issuers the opportunity to access U.S. public markets without having to become registered in the U.S., and sort of rely on each other's jurisdiction. I think that's something that is of much more interest, and certainly much, if Canadian issuers are able to access investment from the U.S., which is very difficult for them now, especially on a small scale basis, I think that would really help.
Rory, is there a website or some other source that people could go to learn more about this particular issue? The commissions have a website. The BC Securities Commission has a website, www.bcsc.bc.ca. And what about the brokers and law firms connected to this? Do they have websites that people could check out if you just Googled the subject?
Sure. Yeah, absolutely. I mean, all the law firms have websites. We have a pretty informative website, I think, and all the brokerage firms have websites. So yeah, absolutely. There's a lot of information available on the internet.
Rory, thank you so much for speaking to This Week in Money about this very important issue for Canadians who want to see us still be at the top of the leaderboard when it comes to mining and other natural resource development.
Well, thank you very much for having me on. It's been a pleasure.
My guest has been Rory Godinho. He's the head of Boughton Law Securities Group. He's also on the TSX Venture Exchange Local Advisory Committee. The website for Rory's law firm is Boughton Law, spelled BOUGHTON law.com. Well, that wraps up our show for this week. I'd like to thank our guest, Rory Godinho, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.